Hey guys, I'm here with part 2 of this series on taxable accounts. As always, this is not personal financial tax or investment advice. It's just for education. So let's dive in here. There's a lot to be said about taxable accounts, but I want to break down a couple important concepts that are important for you to know if you want to contrast this to other types of accounts, especially what we would call traditional retirement accounts, like an individual pre-tax or traditional IRA or a traditional 401k. Now, there's really two concepts here. I want to talk through what is a capital gain and how are those rates assessed when you actually withdraw money from a taxable account. And the second thing is I want to talk through what is meant by a qualified dividend or an ordinary dividend. And then we can kind of contrast those with some ways that you can utilize this account to be more tax efficient. Now, first, if you have a capital gain, it's simply what you paid for an asset versus what the market value is at a later date. So if you bought a stock within a taxable account and it was $1,000 and it went to $2,000, you're going to pay $1,000 capital gain. The only question is, was it short-term or long-term? Short-term just means you held it for less than 12 months. Long-term means it was 12 months and a day or more. So basically, long-term rates are always going to be more favorable than ordinary income for most people. Okay, so capital gains are usually taxed at either 0%, 15%, or 20% when we're talking about long-term gains. If we're talking about short-term gains, those are going to be distributed to you as ordinary income. Now let's move on and talk about qualified dividends. So in your mind, you need to pair long-term gains with qualified dividends. They're really treated the same in terms of tax status. And then really the more important thing is, what is an ordinary dividend? That's simply when you invest in a bond inside a taxable account and it is distributed to you as income, or you invest in something inside the taxable account that is held for a shorter period so that it is not a qualified dividend. So when that is distributed to you, it is actually distributed to you like it would be ordinary income. Now, why do I say this? The reason I say this is because it's really important for you to think through the strategy of how you're investing in the taxable account. When do you need the money? When might you sell? You need to know the implications in terms of short-term versus long-term. And so it really benefits most people to have a long-term time horizon, or at least understand that if they do liquidate some positions inside these accounts, there are going to be implications such as it might be taxed as ordinary income if it's a short-term gain. Alternatively, you can actually utilize losses in these types of accounts against other forms of income, either within the portfolio or elsewhere. That's really going to be the topic of our next video, and I'm going to introduce that as we go along so you understand how to utilize these accounts as part of your overall financial plan. I'll see you next time.